Hi, everybody. Welcome to Real Estate and Beyond. And I'm Ella Gurfinkel, your host. And today I have Kylie Burke with me. She's an amazing insurance agent with Davison and Associates. Kylie, tell us a little bit about why is Davison different, I guess. Well, let's start with that.
Yeah, so Davidson is a locally owned insurance agency here out of Vancouver, Washington. Part of what makes us different is our ability to write in several different states. Last I checked, we were licensed in about 33 different states. And that gives our customers a little bit of an option when it comes to if they're moving out of state or if they have family in other places, we can still service them and keep them as long-term clients. We also are super community focused, which is something that I think a lot of agencies want to do, but they're not always super successful in. So our goal every year is to donate a salary's worth of money into our community. So it keeps us relevant. Yeah, it's a cool place to be. I really enjoy it.
That is totally awesome. Now, what I really wanted you to say is that you guys are a broker. Yes. And you're not a captive agent for a specific company. So if you want to talk a little bit about that.
Yeah, so we work with about 8 primary carriers and then over 100 carriers overall for more one-off type risks. So if you have vacant dwellings and stuff like that, we also have options for it. Part of what makes us unique is that we have the ability to shop your policies for you. So the captive carriers like Allstate, State Farm, that kind of stuff, they tend to only have their products. And so if you don't fit their product, you don't really get the option to be their customer. Whereas we can work with you to try and find a carrier that works best for you from all of the ones that we offer.
That's how we met. As a matter of fact, a little bit of a backstory here is I had a client actually buying a property to remodel, and the property was, I'm going to keep it PC for this one. The property was not in top shape. I know, we're laughing because everybody can tell what I'm really trying not to say. We could not find insurance to cover because of the shape of the property. And that's where Kylie came into play and came to save the day as well. So that actually gave me the reason for this podcast in the first place. Is a lot of my clients, I do mortgages. For those who don't know, I do mortgages. Mortgage touches on so many areas of real life, it's not even funny. I mean, we can start with insurance, which is what we're talking about here. There is anything adjacent, property management, rehabilitation, construction, remodel, and the list can go on and on. I mean, the obvious culprits, the obvious suspects are usually real estate agents. But like I said, not everybody thinks of all the adjacent industries that we touch and all the additional service providers that we need to talk to and we need to involve in the process. Everybody thinks, oh yeah, I just give you the paperwork and you run with it and bam, I go sign the paperwork and I'm done. I get my keys. Yeah, not so fast, bucko. So Kylie knows just as well as I do, even better actually, about all the issues that we're starting to see with the insurance coverages, insurance cancellations, insurance in general. And I guess I need to take it a step further and say that if you want to buy a house and you don't have insurance in place or nobody would insure the property that you're buying, you're in hot water. You can't close. You have to have insurance in order to finance a home. I mean, you need to have insurance if you have a home, period, whether it's financed or not. That's my firm belief. But in order to close on a mortgage, you need to have insurance. And that's what this conversation is going to be about. Yeah. So, Kylie, what are we up against? Pray to tell.
Oh, gosh. So right now, the industry is changing a lot nationwide. There's been a lot of large catastrophic losses just everywhere. It's not just in the Pacific Northwest where I am. You see a lot of it in Florida, on the East Coast. And carriers right now are really struggling to keep up with it.
California would be another state where
California is a big one right now. California is probably one of the top 5 for struggling to get insurance right now, and it's largely due to the fact that there are so many major losses. Like, they're having flooding down there right now that's causing a lot of damage, and that's going to be reflected. And when it comes to that kind of stuff, it takes about 2 to 3 years for things to really start hitting the market and for insurance to start adjusting. So the effects that we're seeing right now are from 2 to 3 years ago. So think 2020, 2021. There were a lot of wildfires, hurricanes, flooding, all that kind of stuff that happened. And so now carriers are starting to make up for it. People are starting to see their rates increase significantly. They're also starting to see a lot of non-renewals. So that means when the carrier, if they go and inspect the property, which they can do via drone, sometimes they'll order an actual in-person inspection. When they do that, they will look at the property. If the roof looks like it's in off condition, some carriers will say, hey, we need this fixed by X date. Some of them will just say, hey, we want off this risk completely. And then it's up to the insured to find another carrier. And so that's kind of where an independent agent comes in, is that we can step in and either advocate for you if the carrier is willing to allow, like say you have a roof that needs to be replaced. If you have it replaced in X time, sometimes they'll rescind the cancellation, but in those cases, we can also rewrite the risk to a different carrier. So the market right now is just, it's really tough. And for a lot of California specifically, people are having to go through the California Fair Plan, which is the government's answer to nobody else will insure this risk. And it takes a very, very long time to get approved through that. The premiums are usually astronomically high, and the coverage really isn't that great. So it's not the most ideal scenario, but sometimes it's the only situation, and we're finding that more and more.
To actually, I guess, comment or piggyback on what you said about the astronomical premiums, why is it important? I guess I'm going to step in and just say why it is so important when we talk about astronomical premiums. It's not just about the loss of insurance per se, or inability to obtain insurance for a closing, which, like I said, will potentially either put your mortgage, again, everything I do is about mortgages. So it will either put your mortgage on ice, so to speak, until you can find coverage as a buyer, or it will generate the astronomically high premium. And the importance of the astronomically high premium wording is this. Everything we do on the mortgage side is all about the monthly payment. The monthly payment is what drives your debt to income ratio. And if we have originally estimated, for example, that your homeowner's insurance is going to be only $100 a month, but that astronomical premium, let's say, is $5,000 a year, which is more than $400 a month. I'm not using a calculator, don't judge me. Well, that extra $300 a month plus for the insurance may actually disqualify somebody from being able to buy the property they're trying to, or lower their qualifying standard, and they may not be able to actually get the property they want. They may have to opt in for a less expensive property because of that higher insurance premium. So not finding insurance is a biggie, but also the higher or high, sky high premiums are also becoming an issue, because that's also affecting qualifications for a lot of folks. And it's important to know that going in, that if you're located in certain states, like California, for example, or Florida, or I'm sure Kylie will rattle off a few more, you need to actually figure out the insurance situation before finding a house. Because if you can't find insurance, or if the insurance costs are going to be insane, then we as the lender need to know what we're looking at for numbers, because we may be misqualifying you. And that's huge. And frankly, we don't have a crystal ball on the lending side, and we don't always know what we're walking into. We're not insurance professionals. We write mortgages. We write finance. But insurance does become a big puzzle piece that may destroy the puzzle.
Yeah, I always tell people when they're looking into buying a home, the second they find one or two properties that they really like, that they think they're going to put an offer in, that's when you should start involving insurance. That's when you should start looking for an agent. You should start asking questions of what would this look like to insure it. And that way, when and if you do put in an offer on the home, you have expectations ahead of time. And that way your lender is not caught off guard by, hey, we estimated $40 a month and it's actually 120. How do we work this down? And that way everybody's kind of all on the same page and you're not in those situations.
That's a great point. I mean, that's essentially the point that I was making as
Yeah.
well. So I'm glad we're on the same page.
Yeah.
Now, that actually brings me to the next question. And that's something that I get asked by clients all of the time. And that's, what should I be asking for when I'm shopping for insurance? What do I ask my agent? How do I compare insurance? Like, what do I look for? Deer in the headlights, right?
Yeah. Well, a lot of people coming into insurance, I mean, it's a very fickle world right now. And so a couple of things to make sure that you're asking is this a replacement cost? Is it actually insured to the full value of the home? A lot of times what we're finding is that people are under-insuring their homes, which can cause problems if there is a claim. And it's not a fun situation to be in. So making sure that you're actually paying attention to the replacement cost of the home. A lot of carriers will fill out what's called the replacement cost estimator, and I highly recommend that people go through that with their agent because chances are you've been in the home, we haven't. So if I put down that there's laminate floors and they're actually hardwood, that can change the replacement cost there. Other things that you want to look for are deductibles. Some carriers will do a percentage-based deductible. So if you have, say you're buying a $400,000 home and you have a 1% deductible, that's $4,000 in the event of a loss. Most policies have inflation guard on them, and so your deductible will increase as your inflation guard increases. So it's not going to stay that amount forever. So be cautious. Other
Ouch.
thing, I know, yeah. If you have outbuildings on the property as well, it's important to know if the policy itself covers those outbuildings for actual cash value versus replacement cost. What is actual cash value? It's the value of the home or the structure minus depreciation. So if I have a shed on my property that's 50 years old and it's insured at actual cash value and a tree falls on it, I'm probably not getting a whole lot and I'm not going to be able to replace that shed. So you want to make sure that you're getting replacement costs on the home and other structures if you can. I say if you can, some carriers offer it, some carriers don't. There's also other types of things that people don't necessarily think about in the heat of the moment when they're purchasing, but that's stuff like hidden water damage. That's something that's coming into play, especially a lot here in Washington, but also across the states. And that's if you have pipes in your walls that are leaking that you don't know about until they become a problem. Some carriers will actually offer coverage for that. So those are questions to be asking. What does this cover? Why would, in this particular situation, what would be covered here? If it's not sudden and accidental, which are the keywords in insurance, it's not covered unless there's a specific endorsement for it. So make sure that you're asking those questions. What other coverages are there that I can purchase? Some other ones include service line coverage as well. So if you have service lines from the home to the edge of the properties, that's also something that can be quite detrimental should there be a loss. And along with equipment breakdown as well. You know, we have things that service our home. I have an entire HVAC system in mine. And if that breaks down, it's $10,000 to $15,000 to replace it. And I don't want to have to pay that amount of money if I can help it. So my equipment breakdown coverage would kick in and it would actually reduce my deductible in that for that particular coverage as well. So
That's actually a great point. I've never heard of that, so I really appreciate you sharing it. And frankly, that by itself is worth $1 million to me right
yeah.
there because that's actually a biggie.
It's huge, and people don't think about it until they need it. And for example, my sister, her HVAC actually went out in the heat of the summer. It was 100 and some odd degrees outside, and she was terrified that she was going to have to replace it. And luckily, she has the coverage, and it wasn't actually a full replacement situation. But, you know, when you don't think about it until you need it, and if you don't have that coverage, then you're not going to have any help there from your insurance. And the whole idea of insurance is to mitigate that kind of risk.
So one of the things that we look for on the lending side is actually what you also touched on, and that's the replacement value. As a matter of fact, that's one of the requirements of, so everything I look at is from or through the prism of what does the mortgage require? What does the financing require? What are the rules and guidelines? And RCE, replacement cost estimator, is something that has, as of at least a few years ago, been something that we require across the board. And I'm glad you touched on it because that exactly explains why we need the RCE to make sure that our buyers are actually adequately covered. But there is something else that I wanted to ask you because again, we have minimal rules and standards for insurance on the mortgage side. One of them, again, being the RCE. Another one is having the home insured for full replacement value. $10,000 is typically the highest you can go deductible-wise, which frankly I wouldn't recommend just because not everybody has 10K laying around. God forbid something happened to your home. So essentially what that means is that 10K has to come out of your pocket as a homeowner before the insurance kicks in. So not a huge fan. But again, we do have limitations in place, and it's one of them. So woohoo. But the one I really wanted to ask you about is that we actually have to provide for our file, and we pull it, not you guys, but we have to provide a rating on the insurance company writing the policy. So I wanted to ask you your opinion and your take on it, because I found it always very interesting. But again, I'm not an insurance pro. I'm a mortgage pro. So take it away.
That's actually a really great question, and one that's coming up a lot more in recent years than it has ever in the past. And a large portion of that rating is for the financial stability of the carrier itself. So there is insurance for insurance companies, and it's called reinsurance. So most of the carriers that you see, they have this umbrella that they insure all of you under, and then there's an umbrella over them. So what it does, those ratings predict the financial solvency should there be large losses. You've seen this a lot in California specifically. Carriers are pulling out of the state because they can't afford to, or they're completely going bankrupt because they're having to pay all these claims out. They didn't have enough reinsurance. So it's important to know the rating, and we, as an agency, we don't work with any carrier. I think our lowest right now is a B+ rating, and even then that's kind of sketchy. We really want to work with A to A+ as best we can, because that way we know that if there are large catastrophic losses, that carrier will be able to pay those claims and take care of their clients and our clients, and not leave somebody with just a burned down house.
So basically what you're saying is, those late night discount insurance commercials that a lot of people see on TV are not necessarily a way to go, right?
I don't want to speak disparagingly, but if it's a online pay as, here's your coverages, good luck kind of thing, chances are you're not insured properly, and I would really highly recommend not doing that. It's always good to speak with an actual professional in the business, because there's a lot of stuff that are nuanced in the policies that they're not going to tell you if you're just doing it online.
Good point, and I'm glad you answered. I wasn't looking for names specifically. It's literally one of those I saw it on the internet or, late night, but wait, there is more type of commercials that I was referring to. Why is it important that somebody does have the home insured for full value? And again, I think a lot of my questions and a lot of what we're discussing goes to the point that the regular Joe consumer does not really know how to compare different insurance quotes or what specifically to look for in an insurance quote, because all they look for is really that bottom line premium, and that's pretty much all they know. But as far as reading what goes into that premium, I would say most people really, okay, so yes, some will have a clue, but most people I would say have no foggies.
Yeah, and it's definitely one of those things that I would say some people have know just enough to get themselves into a lot of trouble, and others don't know a whole lot at all. And it's important to have replacement costs on your home, or at least insure the home to the full replacement cost, because there's a couple of things that kick in. When you insure the home to a full replacement cost, we call that 100% to value. Most carriers will have a built-in extended replacement cost. So, for example, we have a carrier that, as long as you're insuring the home to the full replacement cost, so you completed the replacement cost estimator, the home is insured for that amount or even slightly over, they'll actually pay up to 125% of that replacement cost. So in those large catastrophic losses, usually the homes become more expensive because materials are harder to find, labor goes up, it's harder to find contractors, etc. So there's an extra 25% built in there. Typically, we recommend, if it's an option, to go up to 150% because we're starting to see those large losses. But there's also something when you don't insure the home to the full replacement value called coinsurance. And coinsurance is quite a difficult situation if you find yourself in that. And what coinsurance does is it's the duty of the carrier to only pay out to the percentage of the insured home. So if my home is worth, for ease of use, $100,000, wish I could buy a house for $100,000. Probably not going to happen.
You and me both.
Yeah, I would have so many. But if it was worth $100,000, and say I'm insuring the home for 75, so I'm insuring it for 75% of the value. I have a claim, and it's a $10,000 claim, and I have a $1,000 deductible. So of that $10,000, if I was insuring the home for the full $100,000, I would have $9,000 paid out by the insurance. Since I only insure it to 75%, they're only required to pay out up to 75% of the loss, which would put it at $7,500, less the deductible. So for a $10,000 loss, I would only receive $6,500 for it. That's a big gap, especially when you start getting into larger numbers and larger losses like that. You don't want to find yourself in a situation where coinsurance kicks in, because it could really, really hurt you, and you might not be able to fully repair your home.
Did I really want to know this? But apparently, yes, I did. And
You do.
yes,
It's stuff people should know.
well, adulting, as I keep telling my little over 20-year-old kids, is adulting is interesting. Mm-hmm. The more you know. So one thing I've noticed happens every blue moon, literally, not too often, thank God, but every, I don't know, 1 in 100 maybe, at least in my lifetime in the business, I would get a client who is denied coverage or is charged astronomical amounts again. Mm-hmm. Because of prior claims. And I know there are two types of prior claims that usually come into play. One is the buyer, the person. Mm-hmm. The other one is the property. That one actually happened fairly recently, and I was shocked that it follows the property, not the person. So that is something that is worth talking about, because I've heard people outside of the mortgage biz, that is, basically in the real world, talk about, I'll just file a claim. And my ears will always perk up, because from the mortgage world and dealing with insurance through the mortgage prism, I know for a fact that the more claims you have, the more you're risking losing your coverage or having your premium hiked through the roof, pun intended. So what do people need to know about filing claims, how it affects them, how it affects their deductible, and how it affects their premiums or even ability to be insured?
Yeah, so claims can get very interesting. The average homeowner, in theory, is supposed to experience one claim every 20 years. So the more claims you file, the more the actuaries and the people that do the insurance pricing side of things say, oh, this person's a very high risk. So When you're looking at filing a claim, there's a couple of questions to ask. Number one, is it sudden and accidental? If it's sudden and accidental, it might be worth the risk, but a follow-on question to that is, what is the total amount of damage? If it's a significant amount, say my basement is flooded, I typically recommend people go ahead and file the claim, especially if it's water, because mitigation is very important, but doesn't always make sense. I've had a client that had a leak in their roof, and they had called me to ask the question, should I file this claim? And I said, well, how much is it? It was only $5,000. And I know $5,000 can be a lot to some people and very little to others, so take that at face value. But at the end of the day, their premium would likely increase more and be surchargeable. That loss is surchargeable for up to 5 years. So while you might get a payout of the $5,000 less your deductible now, your premium is going to increase, and it'll increase for about 5 years, depending on where you are in your renewal. But you're likely going to end up paying more in the long run than you would if you'd paid that claim out of pocket. So those are some things to think about.
Here is, I guess, what everybody needs to know. Mm-hmm. They need to have an agent in their corner, essentially.
Yes.
And an agent who can answer their questions.
Yes.
But also, should there be a situation that may potentially result in filing a claim, really, before they file the claim, they really should have a very detailed conversation about it with their agent. Because, again, the long-term effects and what would be paid over the long term may effectively negate that claim, so to speak.
Exactly. And not every agent is going to be able to say yes for sure that that's covered. We're not adjusters. Ultimately, it's up to the adjuster to determine coverage. But what we can do is use experience and things that we've seen in the past and kind of help walk them through that process. Sometimes it makes sense to file the claim, and there are other times that it doesn't. And I would highly recommend working with an agent who can at least attempt to answer those questions for you, or at least give you solid advice. If they're just saying, yeah, go ahead, file the claim, they're not really working in your best interest at that point.
I guess the analogy that can be made is, if somebody wants to know, so why do claims affect my insurance? I mean, think about it this way. Everybody who drives knows that you get a ticket, your insurance goes up. Mm-hmm. The more tickets you have, the higher is your premium. Yep. So in a way, think about the claims against the house basically in the same manner, that it's really no different than tickets or accidents for your driving insurance, for your car insurance, but when it comes to the home, right?
Correct. Yeah. The biggest difference between claims with home and claims with auto is that there's no fault determination. Sometimes, that's not to say it's all the time, but sometimes there are places where fault does happen in a home claim. But typically it's not an at-fault accident type of situation. You didn't hit that person. There was a pipe that burst in your home. So they do surcharge for all, which is a little bit different. And it's important to remember that whatever is going to work best for you will work best for you, and everybody's financial situation is different. But being able to attempt to at least talk about it with somebody is important as well. If it's a life or death situation, if your home is on fire, please get out of there, call 911 and worry about the claim later. And also same with water damage. You want to make sure you get people in there as soon as possible, because the longer that it sits there, the worse it's going to get. So there are some situations where you don't want to call your agent first, but for the most part, you want to call in and check with them.
That's one part of the claims question. Mm-hmm. Who do the claims follow? Do they follow the person or do they follow the property?
Genuinely depends on the carrier at this point. With the way that claims are working right now and with the way that carriers are looking at things, it used to be very cut and dry. It followed the person and the primary property. So if I had a client that had their primary property and maybe a rental property, the claim would always be surcharged on the primary home. At the moment, there are a few carriers that are starting to show claims from previous owners. And in some cases, they do add premium for that. And in most cases, when that happens, they're going to ask for either verification that the repairs were fixed or an inspection from a licensed roofer, a licensed plumber, or something like that, showing that the incident has been repaired and that the home is in current standing. And that creates a lot of problems on the lending side that I'm not going to lie, gets real frustrating.
Oh, I trust me.
Yeah.
You have no idea what's going through my head right now. It's like, oh my God.
Yeah. I get very
That's a scary one,
frustrated with
actually.
it, but if you the point behind them doing that is that a lot of the previous claims can come up as issues later. And so if something wasn't repaired properly and the previous owner didn't take care of it, and now the new owner, especially if it wasn't disclosed to them ahead of time, if the new owner has it, the likelihood that there will be another event very similar to that goes up significantly, especially if it's occurred in the last, I think, 5 to 7 years. So they're starting to be more cautious about that, and it does get very, very frustrating very quickly.
This is probably one of the most times I've been stomped and absolutely at a loss for words.
Well, I'm just here to make you speechless.
On a video recording, because again, the insurance stuff, I just wish more people knew about that, because like I said, when we run into it head first, most of the time on the mortgage side, we're already in the middle of a deal. We're already in the middle of somebody's purchase.
Exactly.
And then it's like hitting a brick wall while going about 150 miles an hour, like full stop. What do we do now?
Yep.
And
Trying to close on time, and doesn't always happen.
Right. And it's, what do we do? So any suggestions?
In those cases, a lot of times what I usually suggest is just finding a different carrier if there's an option. There are rare occasions where there aren't any other options and it becomes a little bit more of a hassle. But what the carriers are doing when they do that is they're basically saying either we want you to jump through these hoops or place the business elsewhere. And so in those cases, I usually recommend we place business elsewhere. Sometimes the premium is significantly different. And so it might make sense to jump through those hoops, but those are conversations that you need to have with your lender as far as time goes, and then with your insurance agent as far as, okay, what does underwriting look for? Why are they asking for this? I actually just had a situation where a client the loss wasn't disclosed to them when they were purchasing. So this was something they had no idea, and it actually ended up being that there was a legitimate issue with their plumbing. And so they backed out of the house. So it can be beneficial in some cases. But if those types of things come up, usually look for a different carrier.
Actually, circling back to California for a minute, in California, now speaking of, backing out and optional clauses or contingencies, my understanding is that now in California, a lot of the real estate contracts now include essentially a clause that drives the buyer or requires the buyer find the insurance essentially in the first part of the transaction. So I wouldn't say in the good old days, but not that far back, let's say a year ago even, we could tell somebody to find insurance about a week before closing. And typically that was something that happened and happened pretty fast. And frankly, the quotes that I was getting back from my clients' insurance agents or from the insurance agents that I recommended, they were literally, just like that. 15 minutes, half an hour. If I have a relationship with somebody, usually they were able to turn around for me very fast. If the client had, preferred relationship with an insurance agent, same thing. It was super fast. There were very rare instances where it took, I don't know, more than a day or two to get a quote back. But what I'm seeing now is we send the requests and we wait. And we wait. And what I'm hearing now across the board pretty much is from insurance people is that the days of when they were able to issue a quote just off of the automated system that they use for quoting are pretty much well gone, because every transaction now, every insurance quote is going through the insurance company's underwriting first, getting scrutinized, the property is getting scrutinized. Can we get an answer to what in the world is going on there and why.
Yeah, I don't have a direct, like, here's exactly why answer, but it goes back to the state of the industry at the moment. Carriers are losing lots and lots and lots of money at the moment just because of the claims that they're paying out. So what they're doing is they're kind of buttoning down their hatches a little bit and they're restricting their underwriting. So some carriers, if you're a really good risk, if you have a great credit score, no claims, your previous homeowner, all that kind of stuff, you can usually get something faster. But for first-time home buyers, we're seeing a lot more of the sticky situations. And it's largely just due to the fact that they're doing their best to ensure that what's coming through is going to be profitable for them. Because right now, carriers are operating in very bad margins. For example, we have a carrier right now that's actually losing 20 cents for every dollar of premium that it's bringing in, if not more. And so they're
going to be in business for how much longer?
Yeah, and so that's the thing, is that we hear different estimates. I've heard end of 24 things will start loosening up. I've heard mid 25 things will start loosening up. There's no real way to tell for sure. Some carriers addressed it earlier, and so they'll be opening their business back up sooner. And for those that are kind of just sucking wind right now, like, what do we do? What do we do? I would anticipate those particular carriers are going to take a lot longer to get back to that baseline. But the best thing that I can say, if you're going for first-time home buyers specifically, is check the age of the roof. That's huge right now. If the roof is over 15 years old, be careful. We have some carriers right now that will not write roofs that are over 15 years old. And in some states, if they're over 10 years old, they still won't accept them. And most roofs are certified between 30 and 50 years, depending on the type of roof. But it does get really sticky. So pay attention to the roof and pay attention to the condition of the home. What insurance carriers look for is called pride of ownership. And so what that means is maybe not like expertly landscaped yard, but the lawn is mowed. The hedges are trimmed, or at least somewhat trimmed. I need to trim mine right now, but there's no garbage or debris in the yard. There's no like cars lying about. I know some people have a lot of collectibles. And just looking,
but they don't belong in your front yard. I mean,
yeah,
they're collectible.
They really don't. It happens, but it really doesn't. And so just when you drive by a house, if you look at the house and you think, oh, somebody hasn't been taking care of it, that's probably a not great sign, and a good sign that the carrier itself is going to have trouble with it. So pride of ownership and the age of the roof are the two things that I would really recommend to get a smoother process through insurance. But again, that can't predict really if there's been any claims on the home, so that can throw a wrench in things. But yeah, just trying to make sure that the home is in good shape should be very helpful.
That's good to know, and that's great advice. And again, frankly, the age of the roof, that I just learned something new yet again, and it's only been, 30 or so minutes that we've been talking. Yeah. But, Northwest, technically, yes, with, the roofs being certified for 30 to 50, really the useful life of a roof is what, 20 to 25 maybe?
At maximum, yeah.
Considering the beating that they take.
Just a little bit of wind and rain. It's okay. I do know in Georgia right now, they're really having trouble with roofs as well. So it's not just in the Northwest that we're experiencing that, unfortunately.
I would almost wonder if Florida is one of those too, for obvious reasons.
Yeah. Florida's got a whole different set of problems going on with them right now.
Yet another one on the list.
Yeah.
Now, again, you mentioned something that got my lender trigger, I guess. And that is actually something that I tell my clients a lot. Literally, that's a conversation that takes place almost on a daily basis, especially with the first-time home buyers. And that's that your credit score actually affects your insurance rates. And like I said, you touched on that. So I've heard different ways or different explanations, justifications for why, but I would really love for an actual insurance professional to speak to that and how much effect does a credit score have on insurance, and what exactly, like, what do you guys pull for credit score? And again, what can be done about it?
Yeah, so credit is a fickle situation right now. Not all states have credit in their scoring, and there's been some upheaval with that here in Washington specifically. I won't get too far into that one, but if we're in states where credit is taken into effect, it's a soft hit on your credit, so it doesn't ding you
So
like it would.
at least a little bit of good news right there.
Yeah, so it's not, the more you shop your insurance, it's not going to kill your credit score, which I think is a good thing. But your credit score is,
I don't think actually most people know that their credit score is being looked at by the insurance companies. So
right. It's not super clear, and that's part of the thing that we're having across the nation is transparency as far as insurance goes. There are some laws that are in place to help with transparency, but it's still not quite where it probably should be. And so your credit is part of your overall insurance score, which is very similar to your credit score, except it takes into account a few other things. So your credit is a portion of that. Longevity with your carrier is another portion of that. So the longer you've been with your carrier, the better your insurance score is going to be. Your liability limits, and that's particularly for auto, but it also comes into play on the home because it affects your overall score.
So let's hit pause there for a second. So let's use me for an example. I was with Allstate for, I want to say, somewhere between 15 and 18 years. And my insurance kept going up and up and up and up, even though my scores were going up and up and up. And effectively for my loyalty, I was rewarded with higher insurance premiums every year. And then, but I also stayed for different reasons. I also had a very high loyalty factor to my agent, who also became a friend over time. So I stayed. And when she came to pretty close to retiring out of the profession, that's when I took my business elsewhere. And my insurance premium actually went down like by $1,000 a year. So my question, I guess, on that one, on hitting pause, is longevity?
Why?
Really?
Yeah.
Why? I felt like I was being penalized, not rewarded.
It's in those types of situations, it gets really interesting because people that have been with their carriers for 15, 20, sometimes I've seen 30 or 40 years, they're in a very old product that the carrier does not write anymore. So every couple of years, they'll refresh their products and they'll add different types of coverages, different exclusions, different discounts. So as the policy ages, the older products tend to be more expensive over time because they're different and they don't fit a new pricing model. So in those cases, I can't speak towards the captive carriers, but for some of the carriers we have, if you've been with them for 10 plus years, we can do what's called a loyalty rewrite and rewrite them into the new product, and typically it'll save them premium. So those are the types of situations where we want to do that. We actually recommend shopping your policies every 3 to 5 years just to prevent that from happening. And it also helps just to ensure that you're in the best place possible as far as premium goes. So there's a balance between shopping your policies and longevity. And with the current market, there's rumors that longevity is going to come into play more. But at the moment, it's kind of one of those, are you in that sweet spot, that 3 to 5 years, or are you 15 to 18 years in, haven't really looked at your policies, and now you're like, wow, I could have been saving this much all the whole time. And it just depends. Every person's situation is unique. I've seen some people that have been with their carriers, I think particularly State Farm, for 30 or 40 years, and I'm able to save them a lot of money. And then there's some people where I can't even touch them and they've been with them for that long. So it's a very unique situation for everybody.
Wow. So no rhyme or reason on that one. But going back to the credit score, right? But going back to the credit score theme, so to speak, that I think what I really want to emphasize is the insurance companies do, well, again, depending on the state, of course, and Washington is not one of them, but there are many, 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 many states in the country.
Washington actually does have credit scoring back in.
I thought it was.
There's a lot of legislature going around right now, so who knows what it'll be in 6 months. But right now we do.
Wow. Wow. All right, so we're back to that. So the insurance looks at the credit score. It does consider it, and it does affect rates. So that's back to, and yes, I'm going to do a quick plug for my Improving Your Credit Scores video podcast that I did just a little while ago, where you can actually see how you can raise your credit scores and in pretty short order, or enlist some help to do that. But credit scores hit people in more ways than one. And mortgage rates are not the only way they're being hit. It's also the homeowner's insurance, and there are additional aspects, like credit in general aside, there are additional aspects where it comes into play. But again, this is the factor that very few consumers actually understand or even realize.
Yeah, and I think with the insurance thing, it's hidden just enough that it's not top of mind for people. But it is a question that we do get asked a lot: is, hey, are you gonna pull my credit here? And I always tell people I don't get a copy of your credit report. I don't want a copy of your credit report. They're going to pull your insurance score, and it's going to have a soft hit there, and it'll tell me what your insurance score is, and I'm perfectly fine just knowing that.
Well, at least, there are some people like you who are open and honest about the process and educate the consumers, and then there is others. So that's a plug for you, hon.
Thank you. I try.
You're most welcome. What does somebody buying their first home, because that's really what we focus on the most of the time, I guess, or most of our conversations are focused on that. What does somebody, or maybe not even the first time, what does someone like that look for as far as coverage? What gets covered by insurance? What does not typically get covered by insurance? And how do they actually compare the insurance quotes line by line? Because things are called differently by different insurance carriers or insurance companies.
Yes. So when people are buying homes, a lot of times when they're comparing quotes, they're looking at the bottom line premium, not necessarily the coverage. I would always caution people against just looking at the bottom line because, yeah, we do want a lower premium, but if it's at the cost of coverage, it's not really worth it. There's a couple things to look out for, and that's specifically what kind of form the insurance is written on. And it's going to get really technical, and I apologize, but there's broad form and there's special form. So broad form, actually, no, that's not broad form, basic and special. And then there's broad in the middle, but we don't usually write broad at all. Basic, it covers named perils only. So that's usually fire, winds, hail, and water, but not flooding, which is different.
Right.
Goodness gracious.
And that's a whole other.
That is a whole other thing. And typically flood is not covered on any policy specifically. So even if it's a special form policy, still not covered. So basic versus special, you're going to get more coverage from a special form because it will cover everything except specifically excluded perils. So versus the basic, we have 4 or 5 maybe named coverages that will actually be covered. The special covers everything except for specific. So think earthquake, think flooding, think land movement, which is different than earthquake. And I think there's
another one I've never heard of.
Yeah. Think of like a landslide or something where there's like mud flow and stuff like that. That's what they consider land movement. Landslide is also different. And so everything except for specifically excluded perils. And usually the specifically excluded perils are easily obtained in other types of policies. So say I wanted a flood policy or I was buying a house in a flood zone, you can obtain a flood insurance policy. It's just not on your homeowner's policy. So that's something to think about as well when you're purchasing your first home. Is this in a flood zone? And if it is in a flood zone, it better be your dream home because flood insurance can get really interesting very quickly.
And that's a conversation I have with buyers all the time as
yes.
well, because if I see that we're in the flood zone, that's my question to them verbatim. Like, how much do you love the property
Is
that
this
you're
your
prepared
favorite
to
place
pay?
ever? Yeah. And for some
Right.
people, it really is worth it to buy a house in a flood zone. They want to live on the river. They want to live close to the ocean. They have a lake in their backyard that they really like. That's great, but be willing to pay more for your flood insurance. The higher
As in,
risk.
don't be surprised that the price tag attached to that flood
Exactly.
insurance policy, and we're talking that's separate from your home insurance
Correct.
policy, that again needs to be in the know, so to speak. But that's again,
Exactly.
that's like for a whole other conversation,
Yeah, I
actually,
could
because
have a
that
whole
alone,
2-hour conversation with you about flood insurance. It's quite
you and me
interesting.
both, Mister. You and me both.
It gets really interesting, but that's the thing to think about is like what is covered, and ask the agent that you're working with what type of policy is this? Is this a special form policy? Is it a basic? Are my miscellaneous disappearances going to be covered? Special form actually does cover miscellaneous disappearance, and sometimes
Which is what?
it is, I lost it. I lost my wedding ring or something like that. Now, if you have a wedding ring, you should really schedule it on the policy. But for types of situations where something is just gone for no reason, you can actually file a claim for it. That comes back to, again, the claim side of things. Is it worth filing a claim for my $1,000 engagement ring? Probably not. If it's, $20,000, $30,000, you should really have it scheduled. Most carriers have limitations on jewelry and collectibles and furs and that type of stuff as well. So that's another thing to think about is what do I have that's unique? It's unique, hard to replace. It can be a specific dollar threshold, but to each person, it's a little bit different. I would say the biggest one that we need to make sure that you're looking at coverage for is jewelry. Most carriers have limitations on a per item basis and a per incident basis where they'll cover. So usually it's between $1,500 and $2,500 per piece. So if you have an engagement ring that's worth $10,000 and it gets stolen or you lose it, you're only going to get $1,500 to $2,500 for that $10,000 ring. Versus if you schedule it onto the policy or do what's called an inland marine policy, I have no idea how they came up with that name for it. It will actually ensure the value of the piece of jewelry, and it's not subject to the deductible. So there's a lot of different nuances and things for what coverage looks like. And again, I would say talk to your agent about, hey, I have this $5,000 piece of artwork that was gifted to me by my grandmother. Is that covered? A lot of times they'll probably say no. Or they'll say it's limited to X amount of dollars. Here's what we should do. So it's good to have that conversation with the agent of what does this cover. But from a homeownership standpoint, definitely go for a special form and make sure that everything is a replacement cost. There are some carriers that will only insure the roof of the home to an actual cash value, and that's not going to help you in the event of a claim.
Again, oldie but goodie. And to be honest, I don't even know if it stands true anymore because, again, things on the insurance side seem to be changing actually at warp speed. I was going to say speed of light, but,
Drastically.
Here is the inner nerd and Trekkie in me, warp speed.
I think warp speed sounds cooler anyway.
You're right. I'll take it. But what about bundling? Because it used to be that if you bundled, you saved.
Yes.
I'm being a little bit sarcastic for a reason, but I'll let you talk to it.
It is good to bundle still. There are benefits to it, and oftentimes it comes in the form of the multi-policy discount. That's usually the steepest discount you can get. With that being said, I have found more recently that sometimes it's better to place the auto with a different carrier than the home. Situations like this have occurred, particularly when the roof is over 15 years of age. The auto premium looks really good with carrier X, and the home premium, or the home is not eligible with the same carrier X, so we place it with carrier Y, and they're actually paying less overall. That does happen. But there's a couple of things that are really important about bundling that I think people don't quite understand, is that when you have a loss on both your auto and your home, there's a single deductible that applies for most carriers. It does vary from carrier to carrier, so don't take this as a completely ipso facto, everybody does it. But most of our carriers, if you have a loss on the home and the auto, so say like a tree falls on your vehicle and your garage, they'll only charge the higher of the two deductibles. So if I have $1,000 deductible on my home and a $500 deductible on my auto, they will only charge me the $1,000 deductible on my home, versus $1,500 for both. So
that's interesting.
Mm-hmm. And then also,
so if for example, I have FIMC for both auto and home, that would be the situation. But then again, finding out they're different insurance, well, they're different policy numbers.
Correct. Yeah, they're still different policy numbers, but they're with the same carrier.
Good to know. Cool. Thank you for that tip.
Yes. There's also, I'm sorry, I lost my train of thought.
I'm sorry. I didn't mean to get you off track.
You threw me off. How dare you? No, it's fine. I get these questions all the time. Multi-policy. There's also some things that come into play at claim time. With the more policies that you have with a carrier, the better they're going to look at you. So if you have one of those individuals who has a large amount of claims on their policy or on their auto policy or something like that, the more policies they have with the same carrier and the longer they've been with them, the less likely they are to get non-renewed. And it also gives your agent more bargaining power, essentially. So we've had clients in the past, and I don't know any offhand specifically recently, but I know that we've had clients in the past where they had a really string of bad luck, and it just ended up that they had a ticket, an accident, they had a claim on their home all in the same year, and they were being non-renewed by their carrier, and we were able to come back to them and say, hey, this client has been with you for X amount of time. They have all of their policies with you. Will you take into consideration what can we do to get this potentially taken for you to continue coverage for them? And so we've been able to advocate for people just based simply on the fact that they have their policies with them and they've been with them for a long time.
All those things are awesome to know. I mean, there's so much more I want to ask you, but we've been chatting for a while, and the information you've provided, Kylie, has been beyond amazing and beyond valuable. I mean, like I said, I've been learning with every point we've been discussing. I've learned something new every step of the way, and I'm never the one to claim that I know it all. So, but by no means was that the premise to begin with. But I've literally, everything we've discussed, I learned new things throughout this conversation. So if people need your advice, how and where do they find you? Obviously, we're going to post your info, but how and where do they find you? And which states, I'm not asking for the full list of 30-some, but which states are your, let's say, favorite states?
My favorite state. Oh, I can't play favorites. That's not good. I mean, I'm particular to Washington and Oregon since we're right on the border there. But we've been finding a lot of luck in places like Arizona, Nevada in some cases. Nevada's starting to get a little interesting though. Idaho, Montana, Wyoming, some of the Midwestern states. But chances are if I don't have a resource for you within our agency, I'm connected to a lot of people and I can find a good agent as well.
That is awesome to know.
Yeah.
So, of course, we want everybody not just to take the information, but also ask your questions. So, ask your questions below. We welcome your questions and comments. And Kylie, you are amazing.
Thank you.
And I really look forward to our future conversations as well, because every time I learn something new. Yeah. And I can't thank you enough for your time today and for the awesome info you have been providing.
Happy to help. Anytime.